So you've probably seen his name popping up in the headlines, right? Jerome Powell. He's the chair of the Federal Reserve. And it feels like every single time he opens his mouth, the markets go wild and politicians start paying very close attention. But why? Why does this one guy have so much power, and what's all the drama surrounding his job about? Well, to really understand why Jerome Powell is trending today, we have to rewind the clock and look at a crazy story from the past that has a direct line to your wallet. All right, let's get into it. It really all boils down to this one pretty dramatic question. You hear it all the time. Presidents publicly slamming the Fed for raising interest rates, blaming them when the economy starts to slow down. So if a president is unhappy with Fed policy, can they just, fire the person in charge? The answer is, well, it's complicated. And it's all wrapped up in a very specific, very important legal phrase.
The entire idea of the Federal Reserve's independence, the very thing that's supposed to protect our economy from short-term political games, it all hangs on this one phrase in the Federal Reserve Act. Think of it like a legal firewall, built to separate economic policy from the chaos of election cycles.
And there it is, for cause. Now what's so fascinating here is just how high that bar is set. For cause doesn't mean, hey, I disagree with your interest rate hikes or you're making my administration look bad before an election. No, it means serious professional misconduct. But the term is still a bit legally fuzzy, and honestly, no president has ever been gutsy enough to really test what it means in court.
So yeah, this tension between the White House and the Fed, it's nothing new. It's a fundamental conflict that's basically built right into our system. Presidents, they want the economy to be booming, especially when they're trying to get reelected. But the Fed's job is totally different. It's about keeping things stable for the long haul, even if that means hitting the brakes when the party gets a little too wild.
To really get what's at stake here, we need to jump in our time machine and go back to the 1970s. This period is the ultimate cautionary tale. It shows us exactly what happens when that firewall between a president and the Fed gets torn down. And trust me, this isn't just some boring history lesson. It's practically a blueprint for economic disaster.
Okay, so let's meet the two main players in our story. On one side, we have President Richard Nixon, a political mastermind who was absolutely obsessed with winning re-election. And on the other, Fed Chair Arthur Burns, the very guy Nixon himself appointed to manage the country's money. What happened next was a campaign of political pressure that was, frankly, unlike anything we'd ever seen before or have seen since.
And check this out. This chart shows you the sheer scale of that pressure. It's built from presidential daily schedules, and it tracks personal interactions. I'm talking meetings, phone calls, the whole shebang, between presidents and Fed officials. Just look at Nixon, 160 interactions. Now compare that to Bill Clinton, who had just 6. The difference is absolutely staggering. It's not even close. This was an unprecedented level of arm twist.
And make no mistake, this wasn't just a series of friendly chats. Thanks to Nixon's own secret taping system in the White House, we have the actual receipts. We have direct evidence of the threats. In a conversation about Arthur Burns, Nixon was recorded saying this exact quote. "It's a really chilling look at the raw political power being thrown around behind closed doors."
So, how did this affect Burns? Well, his private diary, which didn't see the light of day for decades, reveals just how intense the personal toll was. He actually wrote that the president's features became twisted with uncontrolled cruelty. I mean, wow. This wasn't just a policy disagreement anymore. In the eyes of Arthur Burns, it was like battling the will of an emperor.
So what was driving all this? What was Nixon's motive? Well, the answer goes back to a past failure. He had lost the 1960 election to John F. Kennedy by a razor-thin margin, and he was absolutely convinced that a sluggish economy caused by what he saw as the Fed being too strict was the reason why. He swore he would never, ever let that happen again. For Nixon, controlling the economy meant controlling his political future.
Okay, so here's the billion-dollar question. Did all this pressure actually work? And more importantly, what did it mean for regular people? Let's turn to the data and see how this political drama in the Oval Office spilled out and hit everybody's wallets.
This table is so telling. In the years leading up to the 1972 election, you can see the interest rate, the federal funds rate, was going down. But look at that column on the right, large easing shocks. That's econ speak for the Fed pumping a ton of money into the economy, way more than the actual economic data called for. It was a totally artificial boost. And then, surprise, surprise, right after the election, they had to slam on the brakes to fight the runaway inflation they just unleashed. And this pressure didn't just affect Burns. It created a huge conflict inside the Fed itself. On the committee that actually sets interest rates, there was some serious disagreement. This chart shows that before the election,
A whopping 90% of the dissenting votes from other Fed officials were calls for tighter policy. They could all see the inflation risks coming a mile away. But it looks like Burns pushed through Nixon's easy money agenda against the overwhelming judgment of his own colleague.
So, at the end of the day, what was the real cost of all this? Economic models have crunched the numbers, and they suggest that political pressure, like the kind Nixon applied, leads to a permanent 7% increase in the U.S. price level. Let me say that again, a permanent increase. This wasn't some temporary blip on the radar. It was a lasting hit to the value of every single dollar in every American's pocket.
And this is what brings us all the way back to today, and to Jerome Powell. The Nixon-Burns story is this incredibly powerful reminder of why the Fed was designed to be independent in the first place, and why the pressure a chairman faces really matters. It's not just some abstract idea. It's a structural shield with a very, very practical purpose.
Let's just break down the difference real quick. When the Fed eases policy because the economic data says it's the right move, it can lead to real, healthy growth. But when they do it for political reasons, you get a much, much worse outcome. Inflation expectations become what economists call unanchored. Basically, people and businesses start expecting higher prices, and that becomes a self-fulfilling prophecy. You end up with rising prices, but without the real growth to back it up. A toxic mix called stagflation. It's a stagnant economy with high inflation, the worst of both worlds.
So, the main thing to take away from all this is that Fed independence isn't about being anti-democratic. It's about insulating our economic policy from the 4-year election cycle. That shield is what protects the long-term value of your savings and your wages from being thrown away for some short-term political win. The ghost of the 1970s shows us exactly what happens when that shield breaks.
And this leaves us with one last massive question. If the Fed's independence is there to protect us from politicians, who protects us from the Fed? It's the central dilemma, right? How do you balance the need for an independent, expert-driven institution with the basic principles of democratic accountability? And that right there is a question that we are all still grappling with today.